Hello, I'm Tag.
And this is Bob.
And you're listening to Bob and Tag Talk. Before we start the show, I'd like to point out that the topics discussed on Bob and Tag Talk are for informational purposes only. So please don't take this as investment advice. We urge you to do your own research before making any investment. So today we're going to be talking about taxes, the types of taxes. Specifically, we're going to be discussing income tax, sales tax, GST, and how we can save money on taxes. So what are taxes and what are the types of taxes?
So, as everyone knows, right, I think most of us are familiar with taxes. In a day-to-day life, whatever we buy products, there's always some kind of tax that is associated with it. And people who receive salaries, generally there is something called an income tax that is charged on them. And then if you go with some people who do businesses, generally now businesses taxation is a little bit, they're trying to standardize it using GST, but there are a lot of different taxes that were available, like value added tax, and then some kind of sales tax was also there some time ago. And then some homeowners generally will pay property tax, or sometimes the local city administration will charge taxes for maintenance or some other different kind of taxes. So it is generally every state has jurisdiction on some taxes. Now we are trying to integrate everything into one single tax called GST. So we are trying to standardize it. As India as a country is trying to standardize a lot of taxation.
Right. So taxes are something that we pay to the government.
Yeah, primarily we pay to the government. The main types are income tax, GST, sales tax was there, and value added tax, and then property tax and so on.
So probably we'll just jump straight into income tax.
Income taxes. Yeah.
So income tax is the tax that we pay to the government on the income that we obtain from employers.
Not necessarily just from employers. So income can come from anything.
Right.
So for example, let's take the basic scenario. You are an employee, you work at a company. So what you say is absolutely right. You receive a salary every month. We calculate what is the salary for a period starting from April to the March, and we calculate the total salary, annual salary, and then on that salary we are supposed to pay percentage of tax. So every time the government will prepare the budget for every year. So in that they will announce the income tax slabs for the next year. So generally it is like 5% for income less than this much amount, and let's say 10% for something like people whose income is 10 lakhs and things like that. And then if you earn 10 to 20 lakhs, you may be charged 20% of income tax. Anything more, you are charged 30%.
Right.
So it is like, it is not at 30% of the total amount. Let's say you are earning 25 lakhs, then you are not charged 30% tax on total.
Okay.
So you're charged on the total exceeding the amount of 20 lakhs. So for 5 lakhs, you will be charged 30%. For the 10 lakhs, you will be charged 20%. And less than 10 lakhs, you will be charged the minimum amount, depend on it's a male employee or a female employee, it will be different.
Right. And then you mentioned year. So there's something called a financial year, and then there's another type of year that they talk about. Is it an assessment year?
Assessment year, yes.
So what is the difference between the both?
So for example, we are in the financial, this is what, when we're doing this podcast, we are in July almost.
Right.
So we are in the 2022 and 2023 financial year.
Okay.
So April of 2022 ending on March of 2023, this is a financial year.
Okay.
So the taxes, whatever we are supposed to pay at the end of March or whatever we completely pay, we will calculate on this period. And when you do an assessment, that means the assessment of 22-23 will be done on 23.
Right,
after the March.
After the
financial year ends. So for example, for the previous year, that is 21-22, we will pay taxes, we'll submit our Form 16s and returns everything now. So the assessment year will be this year.
Right.
But it's actually the preceding year is the financial year.
Okay, I get that. So you mentioned that, based on the tax slab, you get charged a certain amount of tax on that taxable income alone. It's not the whole income, it's a taxable income alone.
So as when we talked about Form 16, right? So Form 16 is one of the important documents that an employer provides to the employee. So nowadays it is important to get that particular Form 16 just for confirmation. But now there is also Income Tax Department also has a portal where you can go and you can get something called a Form 26AS.
Okay.
Where it will actually give you all the summary of all the taxes that you have already paid. Generally, what I mean by you already paid is every month when actually you're getting your salary, the tax is already deducted.
Right.
So it is called tax deduction at source.
Right.
So the employer calculates your approximate amount of tax for the whole year.
Okay.
Then he divides it by 12 and he will pay the tax on behalf of you to the government of India. So this process is called as tax deduction at source.
Okay.
So during this process, so at some point of time, taxes are already paid by the employer.
Right.
So you can see the consolidation of how much tax is already been deducted from you in the form called Form 26AS.
Okay.
In the income tax portal, you can always go there and check it out.
Okay.
It's very simple. Now the process is very simple. You just need to go to the website, register you have a PAN card. So using the PAN card, you can set your account and then you can download it. Or even there are different other methodologies where also you can have a tax preparer or some accountant who can help you to get all these details as well. So, or you have a lot of other sites today. A lot of startups are working to simplify the process of paying income taxes and filing returns. So like Clear Tax is really one of the famous ones. And I have personally used something called My IT Returns.
Right.
That is one. So a lot of other sites are there. So there are a lot of different options available for any salaried person to get his details, how much tax he has paid, how much tax he has to pay for this year, and if any rebates are there, if any deductions that he can claim, and then will he get any refunds.
Right. So the Form 26A is to tell you how much you pay,
it will give you a complete summary of your financial transactions and the taxes of the whole financial year.
Okay. And then when the assessment year begins, you start filing your returns on the website or
so when the assessment year, when the tax assessment season begins.
Okay.
So that's when you need your Form 16. You need whatever details you can get from Form 26. You have to compare all the data and see that do you have to pay any extra tax. That's where basically you file the return. It's called an IT return.
Right.
So you have to prepare the return saying this is my total income. These are all the things that I have spent on. These are all the things that I have spent on something which can be tax deductible.
Right.
And any other thing like you have made some donations and things like that can also be tax deductible.
So that's what I was going to get to. So when you're filing your IT return, you can also put in documents which say that, hey, I've made that these investments, these donations, and they are subject to tax deductions.
Yeah.
And you will be able to save money on taxes there.
True.
Okay.
So the process is like, so you know your tax slab. So now you also have to know when the budget is announced by the government. So they are not only just adjust the tax slab, they also sometimes may adjust what all the tax deductions that are available to a salaried employee. Since we are actually going into detail in a salaried employee, we can go into details like something like ATC, and then ATCCC, and then ATE, then so many ATG, and so many other sections are there, which we can actually take advantage of. Sometimes if you are really interested, if you really want to know, it's very simple to understand. But even if you are not really understanding, you can always go to any of these tax preparation sites, or you can go to an accountant for help on filing your tax returns.
So you mentioned ATC. As far as I can remember, ATC is usually for investment related stuff. So if you have like some mutual funds, if you've invested in tax saving mutual funds.
First thing about ATC is the limit. What is the maximum limit? Generally, I think it is only 1,50,000 still now.
I think so.
For most of my employment career, I have 1,50,000. But now I think some new registrations have come up. Sometimes if you own a house, if you're paying a home loan, maybe it can be increased to 2 lakhs, which I'm not really sure of. These things keep changing.
Right.
Sometimes even it's very hard for us to keep track of.
Right.
So yeah, you can always go to the details and see.
So all of these are deductions that you can claim, which you can take
so
advantage of.
So on what you can take deductions on, that the government decides. First is home loans. So you're taking a loan for a home. So it's a liability. So that's why you can claim some tax deductions on it.
Okay.
And then, for example, if you are buying and selling property,
right,
and then if you're selling it at a loss, that means you can claim a tax deduction on it.
Okay.
Whatever loss you make in your financial year transactions, if you consider it, you can prove using any document that you have made a loss on it. You can offset it against your tax. So what are the different losses that can happen? Buying and selling property. So if you sell a property at a loss, you can claim tax deductions on it for a particular whichever year that you want
and at limits.
Within the limit, that's maximum limit.
So that's one.
But actually losses don't have limits. So these deductions are very specific for something like life insurance, home loan, and investments, especially tax instruments.
Okay, tax instruments.
Like tax saving equity funds or something like that. So only those kind of things. That is where this limit applies. If you make losses, there is no limit for you. You can make whatever loss you want. All the taxes you can get it back.
Okay.
So that is the actual trick of accounting. So any liability, so taxes can only be there if you have assets, and not even assets. There are no assets on taxes on assets.
Correct.
There are no taxes on liabilities. Taxes only on income. That's why it's called income tax. It's very important to understand. It's very simple. So whenever you have a home, it's an asset.
Right.
So, but if you take a loan on it, it's a liability.
Right.
So you can take income tax rebate on it, a deduction on it.
Okay.
So that's the kind of concepts that you don't have to understand 100% of it, but yeah, you can just try basic understanding.
Got it.
And then we'll come to the losses, but probably there are different kinds of losses that you can offset against taxes.
Okay.
And then what else? Health insurance is one really good thing that you can always use. Most of us have personal health insurance policies. You can offset it against tax rebate. Maximum, I think the limit may be not more than 5,000 to 10,000. If you have parent insurance also, that also is acceptable. And then
I think that comes under a different section. I'm not exactly sure which section, but
there will be different sections. But you can always find out which section it goes against.
Got it.
Then political donations.
Okay.
And then donations to charity. They can also be offset against income tax. And then what else?
That's the usual things we do. We do insurance, tax saving investments, home related stuff, and then what was the other one? Donations.
And then now we have this tax saving bonds or tax saving equities, mutual funds and so on. So it's a little tricky, but if you really are interested to understand, you can go into more detail. So basically the simple idea is, if you buy a 8-year bond or a 10-year bond, whatever, it may be government, it may be someone who claims, we have to read the terms and conditions carefully, that you can claim tax benefits on it. So those kind of bonds can also be added, so you can claim tax benefit on it. And then equity funds, mutual funds, also some tax saving mutual funds are also available these days.
Got it. So that's all been income tax, and how you can leverage all of that to make sure you don't pay too much, and you can save some money on taxing. Basically.
So basic thing is as much the whole thing is like that. Any money that you set across, you invest something for more than 5 years, it is somehow you can see how you can use it to save tax against it. Even fixed deposits, right? If you take a fixed deposit for 5 years or more, automatically it is considered as tax saving. So, but the thing is, you have to be really careful when opening a fixed deposit with the banks. So when you generally go to the website and open a fixed deposit, if you want to choose a tax saving deposit, there will be a different option, and then a normal fixed deposit, there will be a separate option. Because the banks also, when they fixed deposit matures, and they give you back the money. Sometimes what they do is they will deduct 10% tax and then give you back the money. So if you want to avoid those things, you have some forms that you can submit with the banks to avoid all these things. That okay, this is something that I'm going to claim tax deduction on, so don't deduct tax on it. Or even if they deduct tax, it is not a problem. When you file your returns, if you give the correct data, and then you submit the form, you can claim tax refunds. So that is one really good thing that is there, is even if somehow for some reason you know that extra tax has been deducted for some mistake, or it can be your mistake, accountant's mistake, or anyone's mistake. So there's nothing to worry about, because mistakes generally happen. So what we can do is we have to make sure that we prepare the Form 16 of the next year or whatever current year, or we can revise an already submitted Form 16 and make sure that we provide the right set of data, and we can get the extra tax whatever we paid, we can get it back.
Right. There's also one more thing I wanted to mention. This is from my personal experience when I put money in a tax saving mutual fund for like a couple of for one financial year I did that. So this what I noticed later was that some of those tax saving mutual funds have a lock-in period.
Yes.
So I could not redeem the money from my mutual funds, and I'll be able to redeem it only after 3 years. So that's probably something to note when you're investing in mutual funds and all, especially if it's a tax saving one.
So the whole point is this, like I said, right? Anything that you want to claim tax on, it has to be long term. Now equity mutual funds, I think 3 years is the lock-in period, but generally for an average kind of thing, you can consider that 5 years whatever you're investing on, and then we're investing something on tax saving mutual funds. That is the standard. Now there are some advantages why these 3 years also are allowed.
And one more thing is that whatever investment or let's say donation, whatever you do, it has to be continuous. Like for each month it has to be made. You can't like miss a month, right?
Even if you miss a month, make sure you pay it off and then you claim the whatever tax benefits. Before you submit the Form 16, make sure everything is paid off.
Okay. So it is still acceptable to make a bulk payment for like say...
Generally, yeah. For example, let's say insurance, right? I can pay an annual insurance. I can pay one-time bulk amount. So, but if you do it monthly, that means like you have to give a declaration to your employer that, let's say you are giving the details to your employer. Employer collects all the details from you and he will deduct the tax. So you have to give an kind of, what do you say, kind of your word that you will pay the next 3 months because you're paying monthly. That's the thing. But when you eventually find the Form 16, so the government would know because now everything is linked to your PAN. So when you go to the form PAN and Aadhaar, so when you go to the 26AS, it will have all the transactions that you have done which are relevant in the Form 26AS. It will all be already be pre-populated. So nothing will be missed because everything is tracked. That's the thing.
Got it. So yeah, that's been income tax. So let's like jump into sales tax and GST a little bit. Sales tax was the tax that we were paying initially, and now it's all coupled into
initially
GST.
There were a lot of things called value-added taxes, sales taxes. Every state had its own different taxation. So during the concept, when the GST concept was introduced, the whole objective was to not have these separate state taxes because there are a lot of goods that move from one state to the other. So they want to simplify this, and they came up with this whole GST tax, goods and services tax. So whatever goods you're selling, services you're providing, everything has a taxation. It'll have a standard rates, and these standard rates are quarterly or half-yearly adjusted or sometimes annually adjusted, and the slabs are a little bit different. So, and the companies have to generally follow that particular taxation process as well. And for individuals, generally, this GST will only affect whatever you're buying.
Right.
Income tax will only affect whenever you're getting an income.
Right.
And we have capital gains tax. Capital gains tax applies whenever you're selling some property. The property may be house, land, gold, or stocks, mutual funds.
Some asset.
Any asset that you sell, and you're buying something, you're selling something, you made a profit, and depending on the duration, how long you invested in it and how much you made the profit, it is called a short term or long term. Depending on that, there is a gains tax that is charged.
Okay, so we saw income tax, the GST, which is goods and services tax, and then capital gains tax on what we buy sell as
For an example, to explain GST, it will be like, for example, if you order something from Zomato, Swiggy. So now they're charging 5% GST.
Right.
So Zomato and Swiggy themselves will charge you 5%. Okay. If you go to a hotel or a restaurant to let's say an AC restaurant, you are going to a restaurant and then you're eating food. If you see the bill, there will be like an extra 8% or some percent of GST that is charged. But if you go to a normal hotel, which is not AC, and then you just buy food and then take a delivery, and then you personally take the delivery and come out, you will not have that tax.
Okay.
So the taxation is on services, extra services that are provided on top of food. So food has a different rate.
Right.
And then, like for example, electronics has a different rate.
Okay.
And then let's say for some people, for some businesses, right, it'll be like they are processing some cotton, or they are doing some handicrafts, they are doing some other like trade manufacturing. So every kind of business has different taxes.
Okay.
So everyone has to figure out what kind of taxes they are supposed to charge along with the MRP of the pricing of the product that they are getting.
Oh yeah, that is very business specific.
Yeah.
And I think that is why GST was sort of introduced also, no? So to standardize these.
Standardize the business taxes, yeah. And there are a lot of other benefits also that is there, but sometimes people don't know it. So one of the main benefits of having a business, like I said, we discussed before, it is like offsetting the loss. So for an employee, there are not much losses that you can offset because your income is fixed.
Right.
So your income is every month you are getting some income.
Right.
That is guaranteed. That's the benefit of being a salaried employee.
Right.
And so you will not have a lot of losses unless you like buy something and sell something at a loss.
Okay. Yeah.
Like a property, stock, or whatever it is. So that is the only things that you can offset against taxes. For businesses, it is different. Businesses naturally are risky.
Yeah.
So the benefits given to businesses is if you make losses, you can offset your losses again. So you can make any number of losses. So for example, you put 5 lakh rupees and then you start a business. That's your capital. 5 lakhs is your capital. You may put more and more amount as time goes on. Let's say for example, simple example, you go to a company, let's say Bose Bulk Manufacturing, you buy any product, like you buy 10,000 products of slippers, let's take an example. Now you start a store, you put 5 lakhs of your money, you take a store for a rent, and then you keep your inventory. Inventory is your 10,000 slippers, whatever. And then you sell. Let's say, for example, your business is going good. And you have sold everything, then whatever income, so the profits you have made, the price that you have got from your manufacturing, and the price that you're selling, your margin, and then you calculate your margin, you calculate the profits and say, okay, you have to see how much tax you have to pay.
Okay.
It depends on the cost. If you're earning less than 1 crore, 2 crore and all, GST is not that much. Even I think less than 1 crore, it is not so much. 40 lakhs, 50 lakhs, not much. But if it's a really luxury product, something, if it is going more than 5 crore, then GSTs are higher, luxury taxes higher, and so on. So those kind of things. But if let's say you are making a loss, your whole inventory is unsold, or there is some kind of an accident, or anything can happen in the business because it is very risky, or because of some other things.
Even COVID or something.
Yeah, anything can happen, and your whole inventory is unsold. So what you can do is, you don't have any income first because you're not made any sales, you're not made any profits. So you can offset loss.
Okay.
So whatever loss that you change, you can say the whole amount, whatever I have paid is a loss. Then you can offset the loss for this financial year, or you can break it down into multiple financial years.
Okay.
So that your tax you're paying to because most of the scenarios, it is natural that loss-making business should not pay taxes because they are not making any profit, they are not making any money. They're in a difficult scenario. It doesn't make sense. But let's say 1 year you have not sold that particular inventory, so that year there is no tax because you have lost. But the next year, let's say your sales have picked up, everything has picked up, it's going really good, and you have made a lot of profit. So that particular year you have to pay taxes. But businesses have this kind of flexibility of, let's say, breaking down. Basically, they have to do proper accounting. So that is the first thing. If they do proper accounting and they can break down, for example, their losses into multiple years and things like that, they can really actually claim less deductions for them.
Okay.
So those kind of benefits is there. And for example, any asset that you buy on the name of the company, those assets are belong to the company. So you don't pay income tax on it because that's not an income. For example, let's say you own a business.
Right.
You buy a car, you have to pay some taxes on it.
Yeah.
You buy a car for your business, for transporting or for whatever it is. It is for your business purposes.
Right.
So you don't have to, you have whatever taxes you have paid on it, you can actually claim it back because it is a business expense. It is, without that, you will not be able to do your business kind of a thing.
Okay.
So those kind of advantages are there when you have your own businesses.
Interesting. It's very interesting how taxation differs for the individual and the business.
Yeah. A lot of benefits are there. For employees, the benefits are generally like health, like I already discussed, sometimes food. Like some employees get this Sodexo card. So that sometimes for that tax is not calculated.
Coupons,
food coupons, and then transportation. There's something called as LTA. So where you can take holiday every 2 years. For that holiday, whatever you have, travel money you have spent, that can be exempted against taxes and so on.
Also, house rent allowance?
HRA, yeah. So if you own your own house, you're staying in it. If you have a loan, that is offset against the 1,50,000. But if you're renting, most of the people are renting. So depending on depending on the limit of the rent, for every city there is a limit. So they will calculate, and then your HRA can be claimed as tax exemption.
So I'm also like looking at the salary breakup, whatever we receive. There's also something called a Provident fund. So if for those who don't know, can you explain what a Provident fund is?
So general salary breakup is you have a basic pay.
Right.
You have HRA. Yes, you may or may not have this dearness allowance.
Okay.
Some other like software and other services employees will have something called as enhanced kind of a pay.
What about a conveyance thing?
Conveyance is for everyone. It's become kind of standard, like 1,500 rupees, 2,000 rupees. Depending on your basic pay, a percentage amount is calculated.
Okay.
And then every employer has to make sure that they take care of the pension for an employee. The Provident fund is not exactly like pension, but it's more like a fund that is there for for saving, basically a saving for an employee. So basically what they can do is like let's say depending on your basic pay, a percentage is calculated like 8% or something, and then from your pay 8% is deducted, and then employer also puts that 8% equally to your Provident fund account. So you have a separate PF account created every time that when you actually join a new company.
Right.
And we have this UAN, Universal Account Number also these days. So all this money is actually deposited to your account. When you're leaving the company, you can actually either claim that amount or you can just leave it as it is for a few years. If you're changing your company, it's better recommended to transfer it or leave it as is. So this is mainly for your retirement savings kind of a thing. And there's also something called as voluntary Provident fund. If you want to invest more into your Provident fund account, you can do that. Why do we do it is the important thing is whatever money you save in the account, you get 8% compounded interest rate.
Right.
So there are some very specific government schemes which give 7 to 8% compound interest. One is this Provident fund. It may be 7 point, it will be adjusted like 7.6 sometime, 7.4, 7.8. It depends on the interest rate, it will change. There's also something called as Sukanya Samriddhi scheme, which is also a tax saving instrument, which can be used for your the girl child in the family. So you can actually create an account and then you can deposit up to 1,50,000 every year, and then you can actually
collect it.
Whatever accumulated, it will get 7% to 7.5% interest every year. So it's a very good way of compounding money. Generally it is long term, it is 20 years or 30 years of your employment career, or 21 years for the Sukanya Samriddhi scheme and so on. So any long term investment, government provides these kind of benefits.
Interesting. So
we still have more kind of thing like I think there is something called as bonds for construction, I think is. Or any equity funds that are for construction. That also can be offset against infrastructure fund, I think. There are tax saving infrastructure funds that we can also use. And then initially there used to be something called national saving certificates. And then Kisan Vikas Patra. So anything that you're getting a investment vehicle, you're depositing some money, which is actually used for some specific scheme by the government. So Kisan Vikas Patra is for agricultural things. So it's like a bond basically.
Okay.
So different bonds, and even if you go to HDFC Bank, ICICI Bank, you can get tax saving bonds. That also gives 7 to 8%. But again, it's all long term.
Yeah. So basically, there are a lot of tax saving instruments available. We'll just have to be aware of it and see how much our breakup is.
And it also depends on what age group you're in.
Right.
For some people who are in 20s and 30s, they don't have to worry about a lot of these things. The income is generally not so high, maybe a little bit medium to low. So taxation is very less. But as and when you start earning more, when you're in your 40s, 30s and 40s, maybe you have to go to different tax saving instruments. And when you're approaching your 50s and 60s, approaching retirement, you have to completely look into all these tax saving instruments. You have to be really aware of it. And the best part is always go to an accountant. So anytime you need help with Form 16, you can go to an accountant. They charge like 300 to 500 rupees. Same thing with all these websites and everything. They also use accountants. So they will help you out. They will give you tips what you can do, and they'll give you suggestions.
Cool. So yeah, that's been taxes in India. So we talked about what are taxes, what are the types of taxes. We went into detail about income taxes and what we can do to save money on income taxes. And then we had a look at GST, how GST affects us individuals and how it affects a business and what sort of taxes they pay. And we also had a look at what is the difference between a financial year, assessment year when we pay. And so that's been taxes. And I think that's a good spot to end it there today. Hey, thanks for listening to Bob and Tag Talk. Please consider following us on our Instagram and Facebook pages. We put out weekly summaries of the topics discussed on the podcast. And if you found this episode informative, please like, share, and subscribe.